All right. Thank you everyone for joining us tonight. How to invest in U.S. real estate. So we've got Patrick Grimes that's going to talk to us about 1031 exchanges. So if you're a Canadian and you're thinking about doing a 1031 exchange, I encourage you to speak to a Canadian accountant that understands U.S. taxes, because you have to set yourself up properly for the proper structure. So this information is mainly for Americans, but Canadians can do it with the proper tax structure in place with the proper CPA in Canada or the US to help them set this up. So Patrick, I'll let you start. Maybe give us a little bit of intro. I know you got a pretty interesting story, so maybe share a little bit your story about real estate too.
Sure. Let me, I'll pull up the slide deck. I've got a couple things in here that kind of pivot on my story a little bit. So today, we're going to talk about how to do 1031 exchanges into apartment syndications. So I'm the CEO and founder of Invest on Me. Well, first I need to say that the disclaimer that this is not tax, legal, or financial advice. Just like was just said to you, we are real estate doing deals, and we learn as we go, but you need to seek your own team. I started about 15 years ago. My first investment was a pre-development single family, and I was personally guaranteeing those loans, getting into some pretty large deals where I was hoping to speculate a bit on land and build. Unfortunately, that was back in 2007 timeframe when things did start to collapse, and I did hit that pretty hard. So I came out of that focused on single family and working to de-risk my portfolio by buying assets that were existing as opposed to doing new construction, buying ones that had not been renovated, and doing that in recession resilient markets where I could buy for cash flow, do reasonable repairs to bring it up to known comparables, and write out any future downturns that there were. And so I began doing that. I did that for some time, and it was successful. I was able to purchase properties for a number of years through that process, and built a portfolio of single family. And it wasn't until I eventually met my wife that I realized, hey, look, I've got to scale, I've got to partner up, and I got to build an equity firm, start doing multifamily, because I couldn't spend my nights, weekends, and hobbies anymore doing that. So that's my background. And were there any specific questions on that? You're on mute.
My bad. Yeah, you guys can ask questions if you guys want to. Don't be shy.
And I'm getting a bunch of requests here to let people in from the waiting room, by the way.
Yeah, no, I let them in. There's
Okay.
no more. I don't say anything. Everybody's okay. In.
Great. So at present, I'm the CEO and founder of Invest on Main Street. We buy properties throughout the southeastern states and Texas, large 100-unit plus multifamily, workforce housing, B and C class, in areas where we can buy at a great cap rate, meaning the cash flow. We can maintain stabilized occupancy as we renovate them and bring them up to market. We're currently controlling $300 million at about 3,000 units in the emerging markets, as well as a little bit in the Midwest. We have 7 properties in Cincinnati, Ohio, and a couple near that area. It's 18 total. We help investors build wealth through tax advantage cash flow, limiting exposure to market volatility, hoping for a cleaner, safer, and improved living experience for our residents. And I think we're all about that win-win. Prior to my real estate background, I actually did machine design, automation, and robotics. And on that picture, it's kind of cool because this machine here did COVID test kit assembly. It was originally for flu tests, but it was repurposed for that. And this machine over here, there's 4 parallel robotic cells assembling the rotor, that's the rotating part of the Tesla motor, And over here, this is where we depalletize them. So there's metal stacks with copper bars, a Lockheed satellite machine here, all kinds of different equipment, all over medical device and aerospace and some consumer products. We were very fortunate to be very successful in that endeavor, and it allowed us to build enough to start investing in real estate. Meanwhile, I got a mechanical engineering master's as well as our mechanical engineering bachelor's, as well as a business administration master's and a master's in engineering. I also love to travel. I'm a mountain biker, traveler, kite surfer, mountaineer.
Nice.
Yeah, so now here we are. This is kind of like a snapshot of the portfolio. If you're interested in connecting with me, there's some barcodes down here. Set up a call, add to contacts. I have an Amazon #1 best-selling book I did a chapter in. We do offer a free copy to that. There's a little barcode at the bottom there. I've written in a number of articles. I'm a Forbes author, expert panel contributor. One of them is on 1031 exchanges, a tax-deferred way to build your wealth. So I wanted to bring that in here. And so that kind of brings us into the content of this. And I just went ahead and included the tax code here. It is United States IRS tax code, right? So if you're trading things in Canada, this is not applicable. But if you have an entity in the United States and you're trading with an entity within the United States to another property, then it can be applicable to you. It's a transaction where something is sold and then something's purchased, and it's a tax process that is quite complex. Thankfully, they do, and it can be done as an individual or an entity, but I don't believe that's the case since you're in Canada. I believe you would have to be doing it through a United States entity, since you cannot do it as a United States Social Security number, because it is the taxpayer ID that is what 1031 exchange is. So it's the same taxpayer, must be same number before, taxpayer ID to the same number after. But still the most powerful way to build wealth available to normal Americans or investors in America in that case. To make it simpler, there is qualified intermediaries that are required, but they are there to help make sure your investment doesn't get disqualified. So we'll go through that. And so just very basic, and to skip through not read the tax law to you, but if you sell a real estate, you pay capital gains. The exception is if you execute a 1031 and the IRS permits the ability to defer those gains. So it's just a very simple process. Taxes are due when something sells: sales tax, federal capital gains tax, state tax, depreciation, recapture, Medicare tax, all kinds of taxes. Those are examples of the taxes. And so if you do a tax averaging strategy, then average capital gains can sometimes be up to 35%. And it can be a tremendous accelerator. Like I said, it's often referred to as the most powerful wealth building tool available to Americans, or for this meeting, I'll say to the American investor or those investing in America. And the question is to exchange or not to exchange, right? Because if the business case isn't there, then why are we talking about it? And so far, are there any questions? All right, I'll keep going. So if you've invested 25,000, let's just say it's just 25,000. You don't have to start out with a lot, right? And you did it at a 75% loan to value, which just means 25% down, right? And if we assume that the average capital gains was about 35%, and let's say you bought and sold several times, and each time you doubled your equity. All right, so what does that mean? You bought it, you put 25% down, you bought a $100,000 property, right? Then you sold it for $125,000. Well, if you're not doing a 1031 exchange, that means you're paying taxes, right? So on your gains, which would be about $8,700. That means your equity, which could have been $50,000, your rolling equity into the next deal could have been $50,000, is now $41,000. So now your purchasing power at a 25% down or 75% loan to value drops from a $200,000 to $165,000. Now at first, that may not seem like a big deal, but if you repeat it 5 times and you house hack for 10 years, right? You buy a property, you rent it out and you fix it up, and then you sell it and you rent out the next one, you fix it up and you sell it. So what is that? What does your $25,000 turn into after you've done that 5 times? Well, if you did not exchange, your purchasing power is up to 3.3 million. Now, if you're collecting cash flow on that, now trying to retire at 5%, which is very reasonable cash flow, that's 42,000 a year. Much harder to retire on that. If you take the 2 exchange model and you repeat that 5 times, your purchasing power rises from 3.3 million to 12.8 million. You're now cash flowing at 5% on 3.2 million, which is 160,000 a year, which is 4 times higher than 41,000 a year. On the left column, to exchange, you paid 0 taxes. On the right side, you've paid $500,000 in taxes. And so that's just a very simple business case for why we're sitting here talking about this. Anybody have any questions on that? All right, we'll keep moving. So common options for 1031s include purchasing your own property, DSTs, Delaware Statutory Trusts, or tenants in common with partners. And purchasing your own property would just be you taking your rental property, not your personal residence, but your rental property, and 1031 exchanging that into some other rental property, all in your own name, your own entity, doing it all yourself. DSTs allow you to do that. However, DSTs provide some disadvantages. DSTs are for only stabilized properties, which means you can't do a value add plan where you buy it and you refi out your proceeds like we do in all of our deals. You know, we target year 3 getting most of your capital back and still holding for cash flow so you can have multiple streams. Well, DSTs, you can't do that. DSTs allow you to do the 1031 exchange, but they're more like REITs in that they're diluted across a wide, vast portfolio. So a lot of investors come to me and say, hey, the best DST I can find is like a 4 or 6% cash flow. And some of our deals were targeting 8 to 12% average annual cash flow over 5 years. They say, hey, how do I 1031 exchange into one of your larger multifamily deals? And which allow me to get better tax advantages and be able to do refinances and scale faster than you can in a DST. And that's when it shows up in syndications. When a syndicator like me, I'm an individual that will file with the SEC a fund that allows me to raise capital from passive investors, and I will be an active investor, and we will buy large multifamily properties with that equity. And so in syndication, it comes up when an investor calls me. They've just sold their property and they want to exchange into a larger asset, but they want to partner with somebody that can do the heavy lifting. In other words, they don't want to do a DST because then they're succumbing to 4 to 6% cash flow, no refinance proceeds, very limited upside. But they also don't want to be a landlord anymore. They don't want to buy their own property. They want to make sure that they have somebody else who's got acquisitions team to find good deals, asset management to handle the deals, vertically integrated property management to manage it to the door. So they're not dealing with tenants, toilets, and trash. That not only can find the next deal, but then when we've refinanced their proceeds, we'll find another deal for that. And then when we're time to sell this deal, we'll 1031 exchange that. And then we'll refinance that one and start building a diversified portfolio where they can go live in their rocking chairs in their golden years, collecting multiple streams of passive cash flow. And they don't have to worry about it. And so that's when they would call me and say, hey, how do I 1031 exchange with you? Well, it also comes up when a syndicator like myself wants to 1031 exchange forward. And we'll talk about how that works. And for example, we bought a property in Jacksonville, Florida at 27 million last year. It was 200 units. We sold it in December at 37 million last year. Made about 10 and change million in about a little over 9 months. And the investors that we talked to said, yeah, don't hold it. Let's 1031 exchange it. Prices and interest rates are going to go haywire next year. Let's go ahead, buy it March, sell it in December. We then 1031 exchanged those investors into 372 units in Houston. They cash flowed in their investment in Jacksonville, March to December. We shut off the spigot for the cash flow. All of their gains, no taxes, no depreciation recapture, all of their gains, their entire equity multiple went to a qualified intermediary and landed directly into the next property's escrow account at close. And now they're cash flowing at a 2x equity multiple, right? It's a very powerful thing, just to a greater extent in multifamily. So that's the other way that it shows up. So there's two real things here. There's individuals that, hey, I'm a landlord dealing with tenants, toilets, and trash. Can you handle this for me? Can I 1031 exchange into one of your deals? And then there's the deal, the syndicator saying, hey, look, I want a 1031 exchange forward. So that really comes down when a syndicator sells an asset, they really have two options. They liquidate and distribute the gains. That triggers a taxable event for everyone. There's nothing that you as a passive investor, limited partner, can do. Most syndications, they do that. And one of the reasons is because that is the big payday for the syndicator. They want to cash out, right? Some syndicators, though, that are a little more forward thinking, that don't want to pay taxes, that want to participate in the longer term strategy, and those that have significant invested funds of their own in the deals will want a 1031 exchange forward. And so then they'll take the entire proceeds, they'll call up all the investors and say, hey, look, like we did, this is what we're thinking about doing. We're going to sell. If you want to join us on the next investment, let us know. And if not, we'll pay you out. And at close, we'll pay you out. Or at close, we'll 1031 exchange you forward. And so that's the other way, is when we're rolling proceeds forward. Now, there's a couple keys here. Can you exchange your profits from a syndication to a new deal? And if you've invested as a limited partner in the syndication, right? You've invested as a LP, passive investor. You're in a securities offering, right? So yes, you can 1031 exchange with the entity because it's the entity you're subscribing into. But you can't go anywhere you want. You have to go with this entity. Well, who controls that taxable entity? Well, the sponsor does. So you better ask your sponsor, hey, I want to participate in 1031 investing, and I'm going to invest with you as a limited partner. So I want to make sure that you're planning to 1031 exchange moving forward. Because if it's entirely up to them, and if they choose not to do it or they don't succeed at it, which is not the easiest thing to do, then they'll be forced to trigger a taxable event if they don't make the timeline. So it's something you definitely want to check on with your sponsor. There's an option you want available to you. You probably want to make sure, is this part of their strategy? Have they done it before? Have they been successful at it before? Do they have a reason to do it? Are they heavily invested in with their own funds in the deal so that they're with you and it triggers them a large taxable event? Things to keep in mind. Please jump in if you have any questions. So the other one is, can I just invest my 1031 funds as a limited partner into the syndication? This is, hey, I'm a landlord and I want to take my 1031 funds Patrick, and I want to invest them into your deal as an LP, as a limited partner, passive investor. And that's a big no. And the reason why is because investing in a securities offering is what's called personal property, not real property. And one of the roles of 1031s is that you can only go from real property to real property. So when we set up a syndication, it's a securities offering. You cannot buy securities with real property. That's not a like kind exchange. So in this particular case, we're going to say no, but we can set something up called a tenants in common, right? And it's done by creating this tenants in common structure. And tenants in common has been around for about as long as real estate's been around. It's just the process of, anybody that wants to team together and buy a piece of property across the street. It's just the process of going joint title. It means we both have a percentage of ownership over the property. And so we're both tenants, we have common interests, and we're both going to have a percentage of this real property. And so it's a pretty simple process. The structure is that you sit adjacent to the other tenants in common. One of them could be a syndication. Syndication is bringing some funds, right? That entity, you're bringing some funds, and then you guys share ownership. This is just a real rough, purely pictorial, what an example of an org chart looks like when you're doing a syndication. And so here's the apartment building, and you have your asset managers, right? Then you have tenants in common 1, tenants in common 2, and tenants in common 3. Now, the majority ownership in this case is 85% owned by Syndication LLC. And within that, there's a manager, Invest on Main Street. But who's funding that? Well, the funds are coming from a securities offering where we have a PPM, where we have limited partners and active partners. And there's a split between those, a bunch of limited partners and a couple active partners. So this here is the syndication. When you're in a general partner or you're a limited partner, you're not in a tenants in common. It's the entity that has the tenants in common. But if you 1031 exchange your rental property equity into a deal with us, you'll then get a percentage of ownership direct on title, direct ownership over real property. So there's Jane Doe has 5% here, John Doe has 5% here. And so this would be if it's a $1 million property, the syndication puts down, if there's $1 million equity needed for the property, the syndication puts $850,000, Jane Doe puts $10,000 or $100,000, and then John Doe puts $50,000. And that gets you to the $1 million. So in practice, it can be a little more complex than that. For Cottonwood at Park Central, this was one of our deals that we did. This is what this is actually, there was one more entity which I pulled out of here so it would fit, but this is what the org chart looked like. Here's Cottonwood at Park Central. Here's tenants in common 1, 2, 3, 4. This tenants in common actually ended up being a property LLC owned by a husband and wife who both own 50% of it, but they brought enough equity to get 7.5%. That property, same thing over here. There was another one. This one brought 5.2%. And then down here, you have the ownership entities, the management entities over the property. And then you have Class A members and Class B members. This is the syndication. Limited partners are Class A, active partners are Class B. And then below that, you have the owners and the general part. So right here in the limited partners, we have this elsewhere. But then you have all the general partners and their percent ownership. So it can get a little more complex. Everything making sense so far? Pretty.
Absolutely.
What was that?
I know it's making really good sense. I think, especially the visualization, how you're bringing it to the audience. I think it's good to see it.
I see we have a question here. Tech industry based on the slides. I'm an investor at Syndicate. Looking to do 1031.
Gary's got a few questions. I told him we maybe answer them at the end.
Okay. Yeah.
He's got some really good questions.
Okay. Yeah. So the TIC structure, and it's basically what I described. The investor partners with the syndication, receiving percentage of ownership and taking direct title. Tenants in common have direct joint ownership over the property with, quote, equal control in the TIC structure. This can be a problematic. So syndicators will establish joint venture economics and control rights in a side agreement, because there's this no-like trust that needs to happen between you and your partner in any business. But when it's in a syndication, you're a little safer, because on paper it says they're limited partners, limited voting rights. But in a 1031 exchange, can't have that. You can't be in a securities act, can't be in a limited, you have to have unanimous control rights, right? So some syndicators don't want to do it because there's some concerns about the partners that are a small majority owner trying to get in there and make their lives difficult. So establishing a relationship early is good with your sponsor, making sure they know that you're sophisticated with your sponsor is a really important thing. So, but then what they'll do is they'll put some side agreements together to talk about the economics and voting rights. I've also seen individuals like put separate entities in between you and the property that allow them limited rights to sign on closing documents. The last tenants in common I did when we closed we brought about, I don't know, 12 million in tenants in common 1031s. One of the guys was in Peru at the close when it was closing. If we had not set an entity between him and the property, we wouldn't have been able to close, because in Texas he needed to be at the closing table. So there's various things we can do to kind of protect ourselves and our investors from being unable to close or unable to sell. But when you're a TIC investor, you're not forced to go with me, the sponsor. I cannot force a payout of your shares and force a taxable event. And I can't force you to join me into the next deal. If you're happy with how things went in the first deal and we're trading into another deal that's another really great deal, everybody pretty much comes, right? But unlike in a limited partnership investment, if you're unhappy, you can tenants in common wherever you want or cash out at your own discretion. You have real interest in real property, and you can get your own qualified intermediary and put it with him and take it where you like. That's a benefit, right? So because of the challenges associated with the risk, the headache, the partnering with somebody who can sometimes try and make your life a little difficult, creating new contracts for tenants in common and all that, calculating a little bit different return structure on a regular basis, in addition to the credit check, which limited partners don't get a credit check, but tenants in common do. They also get a know your customer, right? KYC. Those, so that they know you're not a Russian oligarch. The bank requires all this, background checks. Are you on the FBI watch list? All that stuff gets checked. If you're investing significantly enough, like over a 20%-ish range, but it's really up to the lender, they may ask you for a personal financial statement or a schedule of real estate owned, if it's a substantial enough, or if the syndicator doesn't trust you or doesn't know you. I know that there was one investor that we just asked, hey, we need your schedule of real estate owned, we need a personal financial statement, and we're running a credit check before we introduce you to our lender. Because wait, we're partners on a multi-million-dollar deal, and I want to know who I'm partnering with, right? And so those things will likely be asked. And if there's a lot of resistance to any of that, these sponsors are going to be very gun shy about partnering with you, right? Because transparency is really important in partnerships. All this has a cost. All of it does. The underwriting fees, sometimes the lenders consider more partners. You can only have as more risk. Lender requirements can be complex, especially in this environment. They're sometimes dialing back the tenants in common. If you produce, we just had this happen where a lender pushed back and said, hey, we're questioning the rate that we capped you at because you're bringing in these tenants in common that are $1 million when you have an $18 million raise. This just happened a couple of weeks ago. Well, one of them was a family office. So we put a $35 million, personal financial statement out there, and that ended it, where he was able to proceed and come into the deal. If the person is not that sophisticated, then it may not have happened that way. It's important for us to know all these things up front so we can navigate those waters. You have to take a light underwriting. It's not a big deal. To answer your question, you should not have to sign on the loan unless it's a significant amount, like 20% of the total raise needed. Most lenders don't require you as a tenants in common to sign on the loan. If it's very small, you may not even need to schedule a real estate owner or personal financial statement. Also, if you have a disregarded entity between you and the property, that gives the sponsor the ability, limited rights to sign on closing docs and stuff like that. That's also a level of security that the lenders will appreciate. We talked about costs, so attorney's fees to set up entities, to write operating agreements, write the tenants in common agreement, write side letters with control rights, profit sharing agreements, negotiate those, speak to your qualified intermediary. They're a huge pain in the ass for the most part. They're very underpaid. They only get about $800 to $1,000 per exchange. It's kind of a dying industry, and there's a ton of work for them, and there's a lot of liability for them. So if you're thinking about doing it, we have some that we worked with a good experience. We've had others we've had an extraordinarily bad experience with. We had one wait till, a partner of mine had one QI wait till a couple hours before wiring the funds until the deadline. Just the funds came in 2 hours on the day of close. So lender will sometimes charge small underwriting fees. Accountants teams, we have to do the constant accounting. Timing is critical. We have the 45 days to identify. This is all the 1031. So from the time you sell your property, you have 45 days to identify up to 3 properties. And then from there, you have the total from day 0 of 180 days to complete the transaction. Now, what does that mean? Well, that means you need to coordinate with the sponsor, the syndicator, in advance. Syndicators don't reveal deals early. We have not unveiled our next deal because we're still wrapping up the raise for our last deal, but we've already established the syndicator, the tenants in common investors for our next deal. Because one, they built a relationship with us before. They told us, hey, I'm going to sell a property. And when I sell the property, what do you have coming up that I can exchange into, right? And so we already know. Also, until we get through not only getting it under purchase and sale agreement, but we get through the due diligence, and then we come home, we renegotiate the PSA, and then the minute we put up the hard earnest money, that is usually 30, 45 days to close. Well, how are you going to sell a property in that time, right? And by that point, we're immediately putting in the loan application, because the loan application needs 30 to 45 days to close. But we need to have all our tenants in common, our org chart, put in the loan application. So by the time you see me send out a deck, you may have missed the boat. Sometimes I'll send out an email saying, hey, early access, we have a new deal coming up, early access to 1031 exchange investors. If it's something you're interested in, let us know now, because we're establishing those partners, and that will be for a future deal. Now, we're not going to have the polished deck, right? There's going to be limited information. We're going to have the underwriting, maybe some rough returns. We haven't got the final CapEx. We haven't got the final due diligence, but we have everything you need to say, hey, plus or minus 5 or 10% of this is what it's going to be, right? But if you do it early enough, you contact us early enough, then we can exchange you directly from one to the next, and you don't have to sell your property. Oh crap, what am I going to do? I have 2 or 3 guys right now saying, when I have 40 days, when I only have 2 weeks left to identify. And you still look at that, happens all the time. Whereas other individuals are calling me saying, hey, I'm going to list it now. What do you have coming up in the next 60 days? And we'll give them the next 3 properties to identify that we have coming up. And so before anybody knows about it. So, and there's limited numbers of tenants in common we can bring into deals. We can't bring in, it used to be before syndication was a thing, that I've heard stories actually from investors I've talked to that had like 30 different tenants in common on one hotel deal. I can't imagine 30 different active people on one deal. So so now that syndications are around, lenders want to see 1, 2, 3, 4 max, right? They don't want to see a ton of GPs. They don't want to see a ton of tenants in common. You need to have a reason why. So there's limited number available. So you want to get in the hopper soon. And by far, it's a relationship business. So the sooner you can develop a relationship. So what my recommendation is it can take 90 days to sell a property, right? I would say when you start thinking about selling is when you should start talking to your syndicator, get in the hopper for the deals he has, or early access to the deals he has coming up. So just like-kind property, so real property to real property. It's not for your single family home. It's not for your vacation home either, unless you've been renting it for enough time, call it 2 years, and you're showing income for it. Then I've seen that get by, but really you got to talk to your CPA. Great. There are some rules around replacement value and combined value if you're doing more than one. Then there's same taxpayer rule. This is what I said. I think for Canadians, you'd be limited to the entity because obviously Social Security numbers wouldn't apply in this particular case. But I've also heard from people, hey, I sold the property, I want to exchange, but they didn't get a qualified intermediary. You never take possession over the investment. It goes from the disposition, the sale proceeds go directly to the escrow account of a qualified intermediary. And then from there, it goes not to the same account that our limited partners put their funds in. It goes to the title companies or the lawyer's escrow account for the sale. So 1031 funds don't even go to the same place that our LPs wire their funds. It goes to the escrow account at the title company. That's where it goes directly. It's got a different location. So it skips the syndicator altogether. It goes directly to the title company. Skips you and the syndicator, the sponsor altogether, right? Qualified intermediary can make this difficult. They can have rules like, well, until we get the finalized contracts, the loan docs, we will never distribute within 5 days. And so you really got to stay on top of them. You got to get it wired 2 weeks early, right? That's really what you want to do because you don't want to be left behind if your qualified intermediary goes to lunch, and we've seen that happen. So just kind of wrapping up a couple things. So a lot of individuals call me wanting to do single family to multifamily trade ups, like me. That's me too. And so that's why I got into 1031s to begin with. And essentially is if you have one home, it's difficult to get the equity oftentimes at $1 million. $1 million is pretty much the number where most syndicators that do 1031s are saying, yep, I'll do it for $1 million. It's solving a problem for me, right? It's a headache, but also I don't have to talk to all these investors. I just bring you in, we can do that and we'll make it happen. Some are like, well, if we've already got one tenants in common, then the cost of doing a second one, and if I know, like, trust you, then maybe I'll go down to 500. That's the lowest I've ever gone. And so we've done that. It's fine. But how do you get single families with that much equity? And how do you time it? How do you time it right so that you get multiple families, single families all sold if it takes that? And how do you control the closing? Because oftentimes if you're selling a single family to, a mom and pop, they may not qualify and it may fall out. And then over and over again, you might have some trouble. Essentially what my recommendation is, and has been to single family investors, is to not fall in this trap, is to consider their single families, if they're occupied, don't get in the mindset where you need to empty them out, create a cash flow drain, send it to a realtor to stage it and sell them all to independent mom and pops because you're worried about that 5 or 10% extra you might get by selling it at the top of the market. because on the other side of it, you'll get hit with massive capital gains, right? If it fails, because that's the most risky process to time, especially when you add more than one single family. And so what I say is, look, just sell it to an investor, not the ones that are calling you calling me saying, hey, I want to lowball you, but sell it to a turnkey investor that wants to buy cash flow income generating real estate and wants to give you a reasonable price for it. And to find those, you need to find the local brokers that work with investors, people that are building out their single family portfolios, not the fix and flippers, not the cash buyers, those guys. And so you find one of those, say, look, I have this portfolio, 1, 2, 3, or 4 properties. I want to sell them all at once in one transaction. You can actually, and if it's a sophisticated investor, because they're occupied and income generating, and it's not mom and pop moving to town, selling a house, timing it with moving to town into a new house, they're going to be more flexible on the closing. It's going to be more stable and flexible on the closing. So you can oftentimes put in the PSA requirements that say, hey, if my 1031 falls apart, then I want an extension. I want an extension as a seller. I want an extension. And that allows you, like, for example, if you're working with a syndicator and all of a sudden at the last minute his deal falls apart, hey, Mr. Seller, I want to exercise my extension so that I can have another 30 days to find another 1031 property. No hard feelings. You've got the sales price already negotiated. You're not losing out. He's not losing out, right? It's not a big deal. And so now you have not collapsed your 1031 because you tried to sell all the properties independently. So that gets you to probably the best way to do the 1031 exchanges from a single family portfolio forward. And then don't forget that if you're a syndicator wanting to raise capital, that tenants in common have existed for way longer than syndications. They've been around since basically the beginning of real estate. And you don't have to have 1031 funds to set up a tenants in common. What I've discovered over time is that the higher net worth individuals want to joint venture or set up a tenant in common agreement, even if they're bringing cash to the table. Why? Well, they don't want to have to 1031 exchange with you forward. They don't want to be in a position where they're under your control necessarily with the future of their dollars. They don't want to be married to you. And so essentially what they'll do is we'll just set up like a tenants in common, just like shown. You'll give them a percentage, but they're just bringing cash. That's a huge win. Because in that case, you don't have to time it with the 1031. It's a lot less headache. There's no qualified intermediary. So if you're working with a high net worth individual that's uncommon or uneasy about getting in a limited partnership because they're worried about a taxable event, well, they're right. But if they're putting $1 to $7.5 million up for this deal or considering it, then set up a TIC structure. It doesn't have to just be a 1031 fund, right, for that. And that's it. You know, I have a book out. We're handing away for free to prospective investors. Got a lot of great individuals out there. Lead guitarist of Def Leppard, Phil Collins, Russell Gray from the Real Estate Guys. I have NFL, NBA players, and I did a chapter in there as well. Persistence, Pivots, and Game Changers. Happy to give away, ship a free signed copy of that to any individuals interested. I'm not sure what else I have here. You can set up a call or add me to your contacts. So, and I think that's all I got.
Maybe something that maybe we can talk about too, that I think comes up a lot of conversations these days, is you hear a lot of people overpaying for apartment buildings because they got to do a 1031 exchange. Maybe if you can talk a little bit about that. As a Canadian, you know, we have a hard time understanding that, you know, why they're overpaying for something not to pay on taxes or to defer the taxes.
Well, yeah. So, you know, price is always relative, right? It's really about who will pay for that. And I'm talking to one investor right now who has a $7.5 million TIC. He sold a bunch of land. And I've talked to some others that have very large ticks. And if they've owned it for 10 or 20 years and they've done multiple refinances out of it, then it may be that if it ever collapses, if it ever gets disqualified or ever collapses, the entire amount of their proceeds will be due in capital gains. So the value of their funds only exists if they 1031 exchange. If they don't, it disappears. So they're looking at, do I get to cash flow with these funds next year or not? And if that's paying 10 or 20% more for a property, they really don't care. It's 100% the government's money. When you're spending at that point that it's deferred, it's 100% the government's deferred funds. If you're spending Uncle Sam's checkbook, and if you fail to spend the check in 45 days, but will you write a check for a little bit more? Right? It's just a no-brainer situation.
Awesome. I really, really appreciate the explanation. Does anybody have any questions? I know some people just logged on, but do you guys have any questions for Patrick? And I'm happy to stay on a little bit too after the network if you guys want to.
Yes, quick question on the minimums, whether it's 500K or whether it's $1 million. Does it include the debt, or does it only count the equity?
Yeah, it would be the proceeds that go to your qualified intermediary.
Got it. Which would be the equity or the net.
Yeah. Mm-hmm.
Got it. And in that case, how do you guys take care of the debt portion? Because unless you guys take care of the debt portion, the investors won't be able to maximize the 1031 exchange tax benefits, right?
The requirements are you got to buy a bigger property and you got to take on more debt. So what's the loan to value currently, or what's the down payment or loan? What's the equity percentage in your current property now?
So my situation is kind of the total net worth of the properties would be about 800K, and I think I'm looking at equity at about 350 to 400K.
Yeah, so you have about a 50% loan to value, right? You just need to take on more debt. So right now we're closing on a property in Atlanta that's 75% loan to value. So that equity put forward would give you a much higher price property for your equity, and you would take on much more debt than you currently have. So that would check both of those boxes fairly easily. Now, there are situations where people are like super highly leveraged and we're a low leverage, like we're 68% loan to cost. In the case that it's the other way around, we can work with you on adjusting percentages and stuff like that and split amounts to try and make it so you don't end up paying taxes. But in your case, it's just really straightforward. It's advantageous to go as low leverage as possible.
Got it. Got it. And in the TIC structures, how is the depreciation distributed?
So that is your straight. So just like how it depends on how they set it up. I've talked to numerous attorneys that it's a highly depending upon what attorney you work for. Just like no syndication attorneys, no attorneys agree on anything, right? Some will set it up as if you invest $1 million as a tenants in common, they'll set up the return structure to be identical to if you invested $1 million as an LP in the syndication, right? They'll set up the profit sharing agreement. Now, the majority of my deals are that way. Now, there are other attorneys that say, no, you can't do that. You need a straight line. You can't have a preferred return. Some attorneys are like, that doesn't make sense. You can't have a preferred return if you're a TIC owner. You need to have a straight profit sharing of your expenses and income from the property, and then we'll take everything out of your share of the expenses out, and we'll pass through your share of the just as a straight percentage. In those cases, what we've done, we just said, okay, how about if we take, if you're putting up 1 million for a $10 million raise, you would have 10% of the property. Well, it's a 70-30 split. So how about we give you 20%? Or sorry, how about we give you 8 instead of 10%, we'll give you 8%, right? That way the sponsor can still make a return. We still get paid somehow. We're not taking the full 30, but we're like negotiating at 20. And that way you get a straight flow through of the economics, which would be your percentage straight through of the depreciation, to answer your question, expenses and income, all that. It just depends. And your CPA might have a different opinion, but we set it up both ways, right? If it goes through the syndication, then the syndication docs are going to specify this is how we distribute depreciation and stuff like that. And then depends on the deal, right?
Got it. Got it. That's helpful.
And now in your case too, when you have, 400 in equity, I had an investor, I mean, this guy was worth 500 million, but he wanted to 1031 exchange even his $350,000 property, because when you're that wealthy, you know how to 1031 exchange, right? You know that. So he put up cash or a piece of his trust. He put up 150,000 in the trust, invested as an LP. He put 350 as a 1031. It got him to 500. It kind of say, yeah, you're an existing investor. You're very sophisticated. You know what you're doing. You're going to be busy. You're going to let us execute the plan. This particular property allowed for smaller ticks because it was a little bit smaller. The lender was more flexible. So yeah, no problem as long as you come total in at say 500K. But then again, he invested $1 million into another deal, so it's all relationship.
Yep, got it. And just for, if in case there are no other questions, I don't want to hog everybody's time as well. But if in case there are no other questions.
Can you stop sharing your screen, Patrick, so we can get a better view, if you don't mind? Perfect.
There we
go. How is the like kind actually defined? Means, is it like it can go from single family residentials to multifamily, or single family residentials to commercial, industrial, offices, RV parks, campgrounds, or there are some limitations?
No, yeah. So like kinds of rental property, you can go rental property to rental property. That I'd say that would be another area where I've heard debate. In the tax laws, there's people will like fervently, adamantly claim one thing versus the other. The next CPA or attorney will claim the other. But for the most part, if you do real property to real property, you should be okay. Some people say it's got to be rental property to rental property. I know somebody who's doing a land right now into a multifamily, and his team is 100% sure that's fine, right?
Got it.
Anybody else have any questions before we let Patrick hop on the plane? All right. Well, thank you so much, Patrick, for your time today. I appreciate everything. Have safe travel, and hopefully we'll connect again.
Yeah. So I'm going to drop my my email here in the chat. Patrick@investonmainstreet.com. If anybody has because every 1031's got some nuances. Anybody wants to just shoot the breeze and nerd out about 1031s, happy to do that. Go ahead and drop me a note. Look forward to it. Thanks for having me.
My pleasure. Have a good day. Take care.